Early 1800s, European governments had embraced debt. They borrowed for wars, for infrastructure, for operating expenses. But there was no organized market. Each loan was negotiated individually. Interest rates varied wildly, and only the wealthiest merchants could participate. Nathan Rothschild changed that. He industrialized sovereign debt. The Rothschild family started as money changers and traders in Frankfurt. By 1800, the 5 Rothschild brothers had established banking houses in 5 major European cities: London, Paris, Frankfurt, Vienna, Naples. This network was unprecedented. They could move money across borders faster than anyone else, and they used this to dominate sovereign debt issuance. Nathan Rothschild in London was the strategic genius. During the Napoleonic Wars, Nathan arranged loans for Britain, but his innovation was how he structured them. Instead of lending directly to the government, he bought government bonds at a discount and resold them to investors at a markup. He created a secondary market. Government needed money. Rothschild provided it immediately. Then he sold the bonds to pension funds, insurance companies, and wealthy individuals. The government got its money fast. Rothschild collected the spread. And investors got a tradable asset. But here's where it gets darker. Rothschild didn't just finance governments. He positioned himself so governments had no choice but to use him. In 1815, at the Battle of Waterloo, Nathan Rothschild famously learned of Napoleon's defeat before anyone else in London. His courier network was faster than official channels. He used this information to manipulate the bond market. First, he sold British bonds, signaling that Britain was losing. Prices collapsed. Other investors panicked and sold. Then, after prices crashed, Rothschild bought massive quantities at rock-bottom prices. When news of British victory arrived the next day, bond prices surged. Rothschild made millions, not from insider trading as we'd call it today, but from controlling information and market timing. This established the Rothschild model. Control the information, control the issuance, control the market. By 1820, the Rothschilds dominated European sovereign debt. If a government needed to borrow, they went through the Rothschilds, because the Rothschilds controlled the investor network. They had the distribution, and they set the terms. Here's why this matters for the debt trap. Before Rothschild, governments could theoretically refuse to pay. If a king defaulted, his creditors lost money and the system reset. But Rothschild made sovereign debt tradable across borders. A British bond might be owned by a French investor who sold it to a German bank who used it as collateral for a loan to an Austrian aristocrat. The web of ownership became so complex that defaulting wasn't just refusing one creditor. It was collapsing an entire international financial network. This is the Rothschild innovation. Make debt so interconnected that default becomes impossible. Not because governments are responsible, because default would trigger systemic collapse. Governments became trapped. They had to keep paying. And they had to keep borrowing to pay the interest on old debts. The debt trap was no longer just permanent. It was inescapable. The Rothschild family wealth peaked in the mid-1800s. They were the richest family in the world, richer than any king, and that wealth came from one source: interest on sovereign debt. They didn't produce anything, didn't build anything. They lent money to governments and collected interest forever. The system Patterson created in 1694, Rothschild industrialized by 1815, and every government in Europe was caught. By 1900, America was becoming an economic powerhouse, but it still had a primitive financial system. Banks operated independently. Money supply was tied to gold, and there was no central mechanism to manage debt. J.P. Morgan fixed that, not for the public good, to protect his banking empire. In 1907, there was a financial panic. Stock prices crashed, banks failed, and the economy seized up. J.P. Morgan personally organized a bailout. He gathered the major New York bankers in his library, locked the doors, and forced them to pledge their own money to stabilize failing banks. It worked. The panic ended, and Morgan became the de facto central banker of America. But he was 70 years old. He knew he couldn't do it again. So Morgan and his associates, the most powerful bankers in America, designed a permanent solution. They needed a central bank. But Americans hated central banks. The first and second banks of the United States had been shut down by populist opposition. So Morgan's group disguised it. In 1910, Morgan's associates, including Senator Nelson Aldrich and representatives from the largest banks, held a secret meeting on Jekyll Island, Georgia. For 9 days, they designed the structure of what would become the Federal Reserve System. The meetings were secret because they knew if the public found out that bankers were designing the nation's monetary system, there would be riots. The plan was brilliant political manipulation. The Federal Reserve wouldn't be called a central bank. It would be called a Federal Reserve System. It wouldn't be one institution. It would be 12 regional banks. It wouldn't be controlled by Wall Street. It would be overseen by a board of governors appointed by the president. It looked decentralized, democratic, public. But the structure ensured banker control. The regional Federal Reserve banks were privately owned by member banks. Those banks elected the boards of the regional feds, and the regional feds elected the Federal Reserve Board. The government appointed some members, but the bankers controlled the system. And the most important power, the power to create money and buy government bonds, was given to the Federal Reserve Bank of New York, which was controlled by the largest Wall Street banks, Morgan's banks. The Federal Reserve Act passed Congress in December 1913, largely because most representatives didn't understand what they were voting for. And immediately, the debt trap expanded. Now, the government didn't just borrow from banks. It borrowed from the Federal Reserve, which could create money to buy bonds. Unlimited demand for government debt. Here's why this matters. Before the Federal Reserve, there was a limit to how much the government could borrow. Banks only had so much money to lend, but the Federal Reserve could create money by purchasing government bonds. The government issues a bond. The Fed buys it with newly created money. The government spends the money. And the debt goes on the Fed's balance sheet, backed by nothing but the promise that taxpayers will service it forever. This is the mechanism that enables infinite debt. The Federal Reserve ensures there's always a buyer for government bonds, always demand, so the government never has to stop borrowing. It can roll over debt forever because the Fed will always buy it. And the interest payments flow from taxpayers to the banks that own the Federal Reserve System. Morgan died in 1913, the same year the Federal Reserve was created. But his legacy is the structure that makes the current $38 trillion in U.S. debt possible. Without the Federal Reserve, the government couldn't borrow at this scale. The market wouldn't support it. But with the Fed as a guaranteed buyer, there's no limit. The debt trap became infinite,